market.
That's true.
Give me your thought. How are you trading it?
Well, I wish I shared Joe's optimism that said that, you know, the biggest move could be to the upside. I can't agree, Joe, right now, because the consumers are telling us with that Michigan consumer sentiment data, Scott, that was the lowest in 10 years, 61. This has been just plumbing lower as consumers are being squeezed everywhere. Food prices, prices of travel, prices to fill up the tank and so forth, energy at home, everything is hitting the consumer. So if we do come out at about 8.2 on Friday, Scott, I guess that's better than a horrible scenario, but that's not the sentiment that the consumer is feeling. That's what the Fed is measuring. What the consumer is feeling is something completely different. So if indeed we did see an 8.3 to 8.5 sort of print on Friday, that would endorse more of what the consumer's feeling. And to my way of looking at things, that would, you know, basically have us erase this 10-point rally like that. I hope that Joe's right, and I hope that we have somewhere between 7.9 and 8.2, and that might be a little bit of a Goldilocks-ish sort of area. But if it's a higher number, Scott, then it's Katie bar the door. We've got really smart folks, Elon Musk, Jamie Dimon, Satya Nadella, telling us batten down the hatches. The consumers are saying batten down the hatches. The only people that aren't saying that are the Fed, and they've been completely wrong the entire 18 months of this zoom on inflation.
They're not the only ones saying it. And you gave me a perfect segue, because Lloyd Blankfein's not saying that. He says, quote, on Twitter, which I found interesting, worthwhile bringing to your attention. This was the other day, or maybe over the weekend. Dial back a bit the negativity on the economic outlook. He says, if I'm managing a big company, of course I'm prepping for the worst. Now, obviously, he's alluding to comments from the likes of Jamie Dimon preparing for the hurricane. But the economy is starting from a strong place with more jobs than takers and is adjusting to higher rates. Riskier times, but may yet land softly. So, Doc, what do you do with that? I mean, here's a guy who knows his way around the world, how to operate a large firm in unsettled environments, and says, chill out for a second.
Well, he says that we have a chance. I'd like him to handicap that chance for us, Scott. If he told me that it's 60-40 in favor of a soft landing, he'd be way alone on that island saying that. I mean, I don't think most people are thinking it's 60-40 or any majority chance at all. I think they're thinking this is a postage stamp that we're trying to land this plane on. It's really small, the possibility that we have a soft landing. Now, it could be softish if indeed the Fed decided to cut back to a quarter point in September and or pause in September. But September seems like a lifetime away right now, with half a point coming now, half a point in July, and then Jackson Hole and September looming. So I would say I respect the heck out of Mr. Blankfein, but it's not a very high probability. And I'd love to hear his handicapping of it. Please, Lloyd, give us a holler. We'd love to hear it from you on air.
Yeah, but I mean, you could say the same thing about Diamond with the hurricane thing, right? I mean, he didn't suggest that it's guaranteed to be another Hurricane Sandy, for example, a superstorm. He threw out a range. I mean, it could be, it's stormy. I mean, it could be a mild storm. It could be a Category 5. I mean, you just don't know. But my point, Shannon, is asking the question as to whether things got way too negative way too quickly, because as everybody has suggested, including the Fed chair on down, we are in an uncertain environment, but one that starts from a very strong foundation.
Yeah, I mean, I think we need to talk about whether we're talking about an economic softening or a true, deep, long-lasting, sustained recession. And that's where the starting point comes into play. If you're starting with 11 million job openings, if you're starting with 3.5 million people looking for jobs, if you're thinking about what is the consumer doing, they are spending less on goods, but many consumers are spending more on services. We're seeing, look at the jobs report on Friday, hiring, leisure, hospitality, professional services. All of those things, to me, don't point to a deep, persistent, sustained recession. And if we are not entering into a deep, persistent, recession, then we have to think about what have we already done in the markets? How much has this adjusted? If you want to talk to me about profitability, are margins going to continue to be squeezed? Are they going to have to work harder to deliver on the bottom line? Absolutely. But preparing for a hurricane, the existing economic situation that we have today does not point to that for this year and likely into the first half of next year.
You think things got too negative too quick? We need to reassess where we are and where we may be going, right? I mean, the market was a sell first, ask questions later kind of a market. And now maybe we need to stand back and take a look at things.
It was, and it did bring down certain companies 70-80% that were completely on the valuation side. But things did get pretty negative. You are seeing demand, whether it's in airlines, you're seeing it in hotels. So people are still going out there. And the question is, how much of demand destruction occurs when rates are this high or going higher and input prices go up? And that's doing part of the job for the Fed already.
That's right.
So the question is, how far does the Fed go when they're already seeing the data come in, and you'll see slowdown, whether it's especially in the goods part.